Let's start today's discussion. Now, we have financial institutions discussion. We started 2 weeks back, I think, with the discussion on central banking, and we have covered central banking and we learned different objectives of the central bank and the functions to achieve such objectives, and some recent developments related to central banking. So now it seems we have very good understanding about the central bank, and I always request you to look at the uh, websites relating to financial sector and as well as the central bank website. On a daily basis, even if you look at the central bank website, there are new information available about the economy and also the financial sector, banking sector, and also new updates relating to numbers, current inflation rate, current exchange rate, current interest rates applicable for banks and the policy rates. All these are available on the central bank. And also if you are into market operations, some of you are maybe with the banks and working with the treasuries, credit operations and all that, and there also you have to know about some of the recent developments in relation to the numbers. And also during last week's discussion, I mentioned to you during the period of this COVID pandemic, the central bank introduced a large number of policies to revive the economic activities, particularly in terms of giving loan facilities to the market and customers, basically the borrowers in the banking system. And the central bank as a policy does not provide any loans directly to the customers. Instead, the central bank facilitates the banking sector for them to provide loans. So banks are providing uh, loans to the customers, but the central bank is basically providing facilities to the uh, banks. And banks, sometimes it's a kind of a on lending. On lending means central bank is providing funds to the banks and they give loans to the market or the customers. And also another way of lending is central bank is giving refinance facilities. Refinance means the idea is the bank would first provide the loan to the customer, and then the central bank will provide kind of a reimbursement of the same loan. Now, under this new facilities to the banking sector, uh, recently during this COVID period, the central bank introduced some new loan schemes. I think you have to have some idea about these loan schemes. For example, the central bank, as you are aware, providing a total of 100 billion, 150 billion facilities to the banking system, which means for the banks to lend to the customers. So roughly 150 billion means a large amount of money to be injected to the economy. Now this 150 billion is allocated to the market for the borrowers under different schemes introduced by the central bank. One scheme is Saubhagya COVID-19 Renaissance scheme. The first, that is basically stage one. Under this stage one, the central bank has already provided more than 30 billion rupees to the market. And then the central bank introduced the same facility, Saubhagya COVID-19 Renaissance Facility 2. where the central bank is providing more loans under that 150 total, the global limit. And then central bank is also providing a kind of a credit guarantee scheme. Credit guarantee means the central bank is providing some cushion to the banking system. For example, now the Saubhagya's phase 1 and phase 2, uh, they are basically working capital loans to the customers. Working capital means, as you are aware, that is to run the business on a day-to-day basis, basically to have the salaries to be paid, and also for maintenance on a day-to-day basis. For those matters, you provide some facilities under this 1 and 2, phase 1 and 2. And under phase 3, that is actually at 4%. The interest rate is 4%, lower interest rate. But under phase 3, the central bank is providing a kind of a credit guarantee to the banking system. Where what happens there is commercial banks are providing loans to the customers at I think it's around 9% interest rate. The loan is 9%, and the central bank is providing roughly, I think, 5% as a guarantee or the support to the banking system. So the customers, again, they can have kind of a benefit in terms of a credit default, actually. So they are actually, the banks will have a facility and in terms of a default. So if the banks default, sorry, customers default, the central bank would provide some guarantee that the central bank will absorb that cost, part of that cost. I think there are some stacks, which means 80%, 60%, etc., etc. And also the central bank introduced a facility for government contractors and suppliers, the segment who have provided services to the government, but the government is due to make some payments to them. So for them also, the central bank introduced a facility that is out of this 150 billion. And also, as you are aware, I think last week I discussed all these things. The central bank has reduced SRR by way of reducing the SRR substantially. Now it's only 2%. As a result, the central bank has injected roughly 200 billion to the market. So a lot of things were done by the central bank to keep enough money to the system, and also facilitate the banking system, and also facilitate the customers to have low cost borrowings. So those are the things done by the central bank. And I told you all these things are available with the central bank website, and there is a press release issued by the central bank with all these facilities, all these information. So I really recommend you, before your exam, you look at this press release. It's a lengthy one, 19-page document, but it's worth reading because you should know what really has done by the central bank during this extraordinary period, and also what are the benefits of these activities or actions taken by the central bank during this period. So I recommend you look at which is available on the central bank website, the actions taken by the central bank to support the economy. So with that, I think we have some clear idea or some detailed information about the central banking activity recently. And with that, let's move to today's discussion. Let me open the slides for you, right? Can you see the slides? Can you, when I put it on, can you see them? So any response? Can you see the slides, please?
Yes, sir.
Okay, thank you. Now, today we are moving to the second part of our discussion on financial institutions. Now, financial institutions here, what we are talking about is financial institutions, FIs, other than the central bank. Now, central bank we have already covered, and we know the central bank is providing some specific service to the economy. They are not similar to other financial institutions. They are unique, or they have a kind of a entrusted specific role, basically through a law, basically through some government mandate. Uh, so in that sense, their role is very specific, and also they are having they are, you know, in terms of their numbers, on one country only has one central bank. Their function is allocated to only that central bank, the legal function. So here we are talking about financial institutions other than the central bank, and these financial institutions, what we are talking today, probably next week as well, because this is a kind of a detailed, lengthy discussion, because we have a large number of financial institutions in the economy, and as a result, this discussion might take 2 weeks. So these institutions, what we are talking today, are basically providing services in relation to one or more of these facilities. So here we have listed down couple of financial services, couple of, in the sense, key financial services in the economy. uh, in a It's a kind of a classification of all financial services into some broad categories. So in that categories, there are certain institutions falling into such categories, or more categories. But for example, one institution can be doing only one of these broad activities, or some institutions might fall into uh, few categories, not only one, more, 2 or 3 categories. So likewise, here what we are providing is a kind of a broad classification of financial services. So what are these financial services that we can observe in the financial system? First one is financial intermediation. So financial intermediation, very simply, I think at the very beginning of this discussion also we talk about the financial intermediation, which is related to providing indirect finance by the market institutions or players. So there what will happen, there will be a kind of a connection between the providers of the funds in the economy with the users of the fund. So these providers, basically, we already know they are the suppliers of funds or the surplus units. Users are basically the borrowers of the money or the deficit units. And as a result, this financial intermediation process is helping us to create new financial assets. For example, when a loan is given, it's a new financial asset in terms of a loan. So financial intermediaries are there in the economy. For example, banks, non-banks, they exchange in basically, so they engage in basically providing financial intermediation. That's one way, one type of a service. The other type is exchanging financial assets, where some institutions, they are helping to trade financial assets, or basically to exchange financial assets. For example, some are acting as brokers and agents on behalf of the clients. Stockbroker is a very good example. He is basically helping to exchange financial assets. buying and selling a particular stock, for example. So there, what will happen? You exchange in a stock or a share. So brokers are helping to do such activity. Okay. Third broad service is creating, buying and selling financial assets in different markets. Now there are some institutions, they are helping to underwrite new share issues. For example, underwriting means they facilitate the issuing shares. As underwriters, what they will do, they will subscribe to the balance part of the issuance. If it is a new share issue, let's say you 100 issue you issue 100 million, and only 90 million is subscribed by the investor. So the 10 million shortage, the underwriter would, buy on behalf of the or for the benefit of the issuer of the shares. Even the central banks sometimes, act as an underwriter. It's not an underwriter officially, but sometimes it does. For example, when the government needs money, the central bank issues treasury bills. And if the market is not fully subscribed into the treasury bills, the part of the treasury bills is bought by the central bank. It's a example for underwriting, but it's not an official or allocated task for a central bank. Normally, private sector institutions, they engage in underwriting. It could be a bank or an unbank or any other institution, they do this such activity. Fourth type is providing investment advice. For example, you might need some investment advice on financial planning. How do you invest your money? How do you look at investment avenues? Or let's say you are a company, you want to have a merger with another company. Merger means you join with the company and form a new one. Or you want to take over another company because you are a big player and you have the market dominancy, and you can, basically take over other companies, similar companies, and become a one institution. So these are basically done with some advice by the certain institutions. For example, there are some investment banks helping these activities. So this providing fine investment advice is also a kind of an activity provided by financial institutions. And some are providing fund management activities. Fund management means they are helping to manage your fund, not only giving advice, they help to manage. Manage means they take your entire asset portfolio and they will decide how to invest in which assets, for the which duration. How do you, basically look at other market uh, available opportunities. Likewise, you are basically giving your funds to be managed by some other institution, like a pension fund. So the pension fund is managing funds on behalf of you. For example, an employee's provident fund, they are basically your savings are accumulated there, your retirement benefits, and they are investing those funds, doing fund management. Private fund management companies are also there likewise. So the financial institutions are falling into broadly into one of these categories, or one or more categories. For example, if you take a bank might be doing financial intermediation as well as underwriting, investment advice. So all these activities can be done by a bank. So it's not a limited to one activity, but institutions we can look at in terms of their actions in the financial system in terms of these activities. Okay. So based on those activities, we can classify financial institutions into three broad categories. Central banks, as I said, we already discussed, and we are not going to cover it here. But the other two are the major activities of the financial institutions. So what are these institutions are doing? Based on the activities that we have already mentioned, we can classify them into two broad categories. Financial intermediaries, what they do is intermediation, and financial service providers, what they do is basically helping for payment activities. So intermediation and payment are the main actions or activities of the financial institutions, and as a result we can divide them into intermediaries and service providers, financial service providers. So intermediary by name is very clear. It's an institution helping to connect surplus and deficit units in the financial system. So this diagram is a familiar diagram for us. There we have the the surplus sector and the deficit sector, and we know in this deficit sector there could be households, firms, government, foreign entities likewise, and these surplus units also form the deficit unit because they are the people who are borrowing as households, firms, governments, or foreign entities. So one firm or one entity can be providing basically funds to the market, as well as maybe borrowing at a particular point in time. So there's no such restriction that they can do only one activity, so they could be doing both. So if you do it through a financial intermediary, we already know it's indirect financing, and if you are doing it through markets, that is basically direct financing. So we are very familiar with this framework, as we have already discussed sometimes back, or the very beginning at this course. So in terms of that, we can define financial institutions as intermediaries as financial institutions connecting surplus units and deficit units in the financial system. And we already know they provide indirect financing because they collect funds from the surplus units and channel funds to the deficit unit. So that is their basically the activity process. So financial intermediaries, they are looking at some certain requirements as borrowers and lenders. So in this chart, as I said, here we have lenders, savers, here we have borrowers, basically the deficit unit. So for them, there are different requirements. So these different requirements have to be matched. In order to have a transaction, in order to realize a financial transaction, financial intermediaries, they have to have these requirements to be matched. And there we have two categories now. We have lenders as well as borrowers. So lenders and borrowers, they have different objectives. They have different requirements. They are not having the same requirements. So a lender might be having a certain set of goals. Borrower might be having a certain set of goals. So these two sets of goals are basically coordinated or channeled by the financial intermediary. So in the middle, here we have the financial intermediary. He takes on account the requirements of the lender and the requirements of the borrower and try to make a balance between two by offering a product to the customer, or to the lender or the borrower. So that product is basically designed and offered by the financial intermediary. So in doing so, what are the requirements of these two parties, lenders and borrowers? So lenders are looking at the expected return. They are worried at their profit. What do they get if they give money to the needy sectors? So when they give money, they look at the return. Typically, when you take the return, when you expect the return, you normally expect the highest return. So always lenders would require, would expect the most possible highest return, the maximum that they want. And when doing it, you have to incur some, other uh, risk factors as well. So risk is a concern for the lender. What are the risks that he is facing? Basically, he is having various types of risk. Under this discussion going forward, we will look at this risk, but keep all the risk aside. That on top of every risk, the most important risk that he is facing as the lender is the credit risk. Credit risk. Credit risk means the possibility of default by the borrower. So as the lender, he has to ensure that he has a lowest risk in terms of getting his money back. So risk is a matter of consideration or concern for the lender. Third one, liquidity. Liquidity means how much how is the tradability. Liquidity, I hope you remember, I defined as the possibility of converting into cash an asset into cash without losses or without delays, undue delays. So liquidity, again, basically if I define it, the process of converting assets into tradable assets, which means basically having the possibility of converting into cash without any delay or a loss. That is the idea. So the lender would look at the liquidity, which means whenever he wants to liquidate the asset, he should be able. Now, for example, when he gives a loan, it's basically a liquidity, providing a liquidity. Uh, for that matter, he is basically having a, maybe he's having an asset for that when you give the loan. So asset could be a real asset or any financial asset or whatever. So that's a collateral. That collateral's liquidity and the possibility of recovering money as soon as he wants, I think it's an important factor. Fourth one, transaction cost. How much you have to incur to enter into the transaction. So the financial institutions, they are worried about the transaction cost because that adds to the total cost of the bank. Usually what happens, the financial institutions, they are, charging the transaction cost from the customer, but initially it's a cost to the lender. So that is an important factor. So those are the key areas that the lender would look at: the return, risk, liquidity, and the cost, transaction cost. How about the borrower on the other side? When he wants to borrow, he is also having some, requirements. He just doesn't go to the bank and blindly borrow. He just doesn't go to the, lender and ask for money. He is also having some requirements or concerns. What are these concerns? First thing, he would be very much concerned about the interest rate, the cost, how much he has to pay for his, requirement. Now, usually the borrower would like to have the lowest possible cost. As long as the cost is low, the borrowers are encouraged to borrow. So that is his first priority. What is the interest that he should pay when he borrows? Important fact. Then the term. Term means basically the duration of the, let's say, a loan, to which period. Now, usually when they borrow through, let's say, a direct mean, you directly borrow from a financial institution. Usually, the borrower would like to have a period, long, as much as he can extend into the long run. So he would like to have the maximum period for a loan. He wants to have the maximum amount as well as the maximum period in terms of the loan period. So the term is an important factor. Again, transaction cost is also a matter of concern for the borrower. He would be worried about the transaction cost because that is basically adding to his transaction. So he would like to have the lowest possible cost in terms of the transaction cost. Size of the loan, the amount that he can borrow. Normally banks, the customers, they would like to have the possible maximum amount as the loan. Now when you borrow in a bank, usually bank does not give loan without any collateral. You have to have collateral. So when the banks keep this collateral, that collateral should be sufficient to cover the size of the loan. So let's say you are borrowing for a housing loan, let's say 1 million. uh, that collateral that you pledge for that 1 million should cover that amount. That is the idea. And also the size, the maximum amount you want to borrow, you ask from the bank. And there the bank will not provide the maximum in terms of the entirety. You can get a maximum amount, but you will not get the 100% that you required from the bank. So banks are just keeping kind of a margin for that. Margin in the sense, I hope you remember under Montepolis discussion, I told you there are some requirements called loan to value ratios. So the loan to value ratio means simply the bank would not give the entire amount they want, so they keep a margin with them. So the size of the loan matters when there is a kind of a loan to value ratio, because borrowers would like to have the maximum amount that they want. Okay. Risk is also a concern, but they are not facing a substantial risk. Now the borrowers risk is mainly coming from the there are two types of risk that the borrower would face. Interest risk, that's one thing. For example, if you have borrowed at variable rates, so you have a cost in terms of going interest rates going up. Even if you are entering into a fixed period, still there is a risk. For example, let's say interest rates have reduced. Now still you are facing interest rate risk because you cannot adjust your rates as per the uh, bank's need. So that interest risk is faced by the borrower. And in addition, if it is a foreign loan or a cross-border transaction, the exchange rate also matters. So the exchange rate risk is one of the important factor, especially when you borrow from abroad. Through the changes in the exchange rate, your uh, borrowed value could change. So these are the requirements that are basically considered by the uh, lender as well as borrower. So the financial intermediary who sits or stands in between tries to make a balance between these two requirements of the borrowers and the lenders. So they try to keep a balance between the two as the financial intermediaries. Okay. Now, let's look at the key role of the financial intermediary. Now, this slide is important. This slide is important because in your exam questions, there are various instances that you have to answer this question. What are the key roles played by a financial intermediary? Or what are the key functions or functionality of the financial intermediary? So you need to have these things in mind. What are the key actions or functions performed by a financial intermediary? When you provide a good answer, you have to have these words or terms in your answer uh, incorporated, because these are some uh, standard words. So the first thing, financial intermediaries are trying to convert short-term liabilities to long-term assets. Now, usually, as I said, banks would get money or non-banks would get money on a short-term basis. Short-term basis means could be 1 day or up to 5 years. In Sri Lanka, we have basically loans, deposits up to 5 years. So these are kind of a short-term liabilities if you look at with the long-term assets. So assets are not limited to 5 years. Let's say some of the loans are going for 25 years. It's a long-term asset. So how do you match this short-term liability and long-term asset? Because you collect funds on a short-term basis, but you have to lend on a long-term basis. So this process, you call it as maturity transformation. Maturity transformation. So banks are doing, let's say, banks means here what I have mentioned, the financial intermediaries, that is our broad category. So financial intermediaries are helping to convert short-term liabilities to long-term assets. That is one of the key roles of the financial intermediaries. Second one, risk transformation. Risk transformation, which means they are converting risky investments into relatively risk-free or risk-low institutions. For example, one particular company or bank could lend not only to one person, maybe to a multiple amounts of borrowers, a multiple amount of investors. Even an investor could do this when he, basically allocating securities, maybe, or when he wants to buy different securities, he can allocate into various categories, buckets, because there is a risk involved. So this part we call it risk transformation. This is maturity transformation. This part is risk transformation. You convert risk assets into relatively risk-free assets. That is the idea. Third one, convenience denomination. Now, the idea is convenience denomination means you are trying to make a balance between different views and different uh, activities in the markets. Convenience denomination. So what they are doing here is you match small deposits with large loans. For example, you are collecting hundreds of small loans. Maybe the total of these 100 loans, 100 deposits, let's say, is only 1 million. Small deposits you collect amounts to 1 million. and that 1 million straight away can be given a loan, as a loan to a person. When a particular person wants to have a personal loan, that 1 million can be given directly. So it is collected as small deposits, but you give a large loan. The opposite is also the same. There could be a large deposit. Let's say one person deposits 1 million. So borrowers, they won't have small loans. Let's say 100 borrowers, they are requiring funds, small amounts of loans. So that large deposit can be used to service the or pay the for small loans. So that part we call it as convenience denomination. Convenience denomination, which means matching small deposits with large loans or matching large deposits with small loans. Okay. Next one, asymmetric information problem is solved by the financial intermediaries. Now, in modern finance discussion, this is considered as very important. Now, actually, these first two, maturity transformation and risk transformation, they are, traditional roles. If you are a bank, you have to play such role. So in that way, it is a kind of a traditional action. But in today's world, information is really important. Information is really important, and people need information to make economic and financial judgment. But what we see is theoretically as practically, there is a huge asymmetry in information available. So when there is an asymmetry, there could be a gap between parties. There's a knowledge gap about the market. So in that sense, you have to have a good market with adequate knowledge. So there you try to attempt this asymmetric information problem, because if the asymmetric information problem is there, that will lead to some other factors, some other problems. Now, if you look at a finance book, let's say Mishkin's finance and banking book, in that book, if you look at asymmetric information, that is related to two major problems. That is moral hazard and adverse selection. Let me type it here. Moral hazard, adverse selection. So these are outcomes of, sorry, what is it? So I'm sharing slides again. What I was talking about is asymmetric information problem. So banks are trying to resolve asymmetric information problem. Banks, in the sense, I'm always talking about banks because they are very important players, but broadly financial intermediaries, what we are talking here is, right? So they are trying to help to solve asymmetric information problem, because that problem leads to some important issues in the financial market. That is basically moral hazard and adverse selection. So these are some adverse developments in the market when there is a asymmetry in the information. Asymmetry in the sense, you basically have a gap between parties in relation to information. So the financial intermediaries, they are trying to reduce this knowledge gap by providing adequate information. So I told you the first few things are actually some traditional roles played by the financial intermediaries, but in modern world, we consider the fourth one as very important because they help to reduce the knowledge gap or the information gap, which is very important to realize a effective transaction. Okay, so these are the key roles played by financial intermediaries. I request you to tag this slide, which means this is an answer for many exam questions in your exam. So it's an important slide. Let's move on. So what are the importance of these financial intermediaries? Why do we need them? Why can't we operate with financial intermediaries? In other words, so we need financial intermediaries because they have some important advantages for us. What are these advantages? First thing, cost advantage. So rather than going for direct lending or borrowing, you can go through a financial intermediary. That is important. Now, if you go to the market directly, as I said, you don't have adequate information, and searching for information is costly. There is a search cost. So in order to avoid such search cost and to have adequate knowledge, and through that to reduce cost, you need financial intermediaries. So the cost advantage is very important. Reconciling conflicting preferences of lenders and borrowers. Remember these different requirements. So these requirements have to be matched to have a financial transaction. So intermediaries, they can reconcile these conflicting preferences. That is also important. Risk aversion. Intermediaries are helping to spread out or reduce the risk because they have analysis on the markets, they have information, they can properly identify risk, and if you want, they can price the risk, they can transfer the risk. We already covered that risk transformation, right? So for that matter, the financial intermediaries are important. Risk aversion. Last two are really important things. I'm putting these things and I will explain this because uh, they are important in terms of advantages. Economies of scale. Now, we already covered cost advantage. This part is also related to that. Now, financial intermediaries, they are providing services in a large scale, right? Financial intermediaries, they have large number of customers. They have large number of savers or borrowers. And through their lending and borrowings, they can reduce the cost. They are not only raising money from one person. They have different savers to raise money. They are not only giving a loan to one person. They have large number of borrowers. So through that, they can enjoy some low cost. You call it as economies of scale. As long as you expand your production, if you are in a production cycle, production plant, as long as you expand your production, you bring down the unit cost. You bring down cost, average cost. That is basically achieving economies of scale. Similarly, financial institutions, as they are providing more services, they can bring down the cost. So whatever the service you get from a financial intermediary, it's actually a relatively low cost because they have achieved economies of scale. Last on economies of scope, it is indicating that financial intermediaries can provide different products and services. They are able to enhance their products and services through the financial intermediary. For example, let's say a bank. A bank would provide you a, let's say, a savings account. That savings account is a product, a facility to provide it to you by the bank. Now we know that savings account will come up with various added features. What are the added features? With the savings account, you get a passbook, you get a debit card, you can ask for a loan based on the savings account. Likewise, if the financial intermediary is providing one particular product, there are different attached services or products given to that attached to that facility. So that is basically economies of scope, providing multiple services at the same time when providing a particular product. So economies of scale and economies of scope are both very important advantages of a financial intermediary, other than the first three, right? First three are actually, we can understand and they are very traditional, but these last two that give some, economic sense to this analysis. Now let's classify financial intermediaries, right? Now don't get mixed up with the classification. Earlier what we have done, we have classified financial institutions. So institutions we classified into intermediaries and service providers. Here we are classifying intermediaries again. Now we can classify intermediaries broadly into three categories: depository institutions and contractual savings institutions, investment intermediaries. Depository institutions means institutions or intermediaries who are dependent on deposits, who are taking money as deposits from customers and giving services in turn. Okay, depository institutions. Other institutions, contractual savings institutions and investment intermediaries, they are also intermediaries, right? Now, contractual savings institutions, for example, a pension fund. Now, we have to realize a pension fund is an intermediary. They have a contract to save for us. Investment institutions, investment bank, they are also providing an intermediary service. We can call them as non-depository institutions. So financial intermediaries can classify into depository and non-depository institutions. Broadly, depository, contractual savings, and investment intermediaries. So this is the classification. Now, why this classification is there? Because the asset and liability structures are different, and as a result, their type is becoming different. Now, this chart or the table is from a textbook, Mishkin's textbook. I have extracted this. So here in this table, in three columns, we have type of intermediary and what are the primary liabilities of this intermediary. Liabilities means the source of funds, which means how do they get money for their activities. In the last column, primary asset, which means how they use these funds. How do they get funds? That is liability. How do they use funds? That is the asset. So in three rows in red, I have given you the types of intermediaries which we have classified here. Now let's say deposit institutions, for example, you can call it broadly banks, or even non-banks you can include here. So I think this bank's word, to avoid the confusion, probably you can cut it here if you have the slide with you, because deposit institutions would include non-banks also. Here under this broad classification, you can have non-banks also. But since I have taken this directly from the book, I use it as it is, but for you avoid confusion, let's remove it banks. So under deposit institutions, what do we have? We have commercial banks. Their main source of funds are the deposits, and they give loans to any other institution or a customer in the economy, for individuals, to the government, to the firms. And there are other type of deposit insurance, depository institutions, savings associations, mutual savings banks, credit unions. And here in this blank line, you can include non-banks, or in our case, finance companies, you can include here, right? So in Mishkin's analysis, they have included finance companies here. This is because this is the table is directly from US context. In the US context, finance companies, they are considered as investment intermediaries. But in our context, actually in Sri Lanka, these finance companies actually can be included here under deposit insurance, deposit institutions, because they accept deposits and give loans. So all these institutions are relying on deposits and giving maybe loans. Mortgage means loans, different types of loans. If you include finance companies here, they also give these loans, mortgages, consumer loans, business loans, etc. etc. But the message I want to convey here is deposit institutions, their primary liabilities are coming from deposits. Primary assets are basically loans. Second type, contractual savings institutions, where I already mentioned to you, there you have some contract with the institution. These are type of long-term institutions. That's why you call them as contractual institutions, long-term. What are these long-term institutions? Insurance companies. Again, this is also insurance. Pension funds or retirement funds. So broadly, insurance companies and pension funds are contractual savings institutions. How do they get money? Premiums. For the insurance, you get premiums. For pension funds, you get contributions. Contribution may be from you, from the employer, or from the government, if it is a government pension fund. Right? So likewise, you get contributions. What are the assets? So these funds or these institutions, they have invested their money in different assets. What are the assets? Basically bonds and loans. So mostly stocks, bonds, more stocks and loans. Now mostly these contractual institutions are the biggest players in the bond market. Why? I told you these are long-term institutions. So they are funding, basically in very long-term funds. Why? If you get an insurance, they know by practice, insurance will be claimed after some time. If it is a pension fund, you have to pay after some time, not immediately. So you can take a long-term position, long-term view in the market, and you can invest in long-term. So in that sense, contractual savings institutions are broadly operating in the bond market and also stock market, because they are long-term capital markets. That's the second category. Third category, investment intermediaries. As I said, in the Mishkin's book, they have put this finance companies, mutual funds, money market mutual funds, and even sometimes you can put some let's say derivative institutions, There are also new type of institutions under these investment intermediaries. So how do they raise money? Through various financial instruments like commercial papers, stocks, bonds, shares, etc. They give or they invest these in things in investments or provide loans. So whatever the asset could be, the asset could be in whatever form, could be investments, could be loans, etc. So the key thing I want to highlight here, depending on their source of funds, which means the liability, the type of institution would be different, and that type of institution would be having different types of assets. If you look at their balance sheets, you will see various types of assets in their balance sheets. Okay, so here we have various types of financial uh, intermediaries list. I have given you a number of financial intermediaries like banks, finance companies, investment banks, merchant banks, leasing companies, building societies, microfinance institutions, credit unions, insurance companies, factoring companies, cooperatives, pension funds, escrow companies, all these are basically coming from this broader categorization. So under each and every categorization, if you want, you can include them. But our purpose is to understand these institutions. So one by one, I'll be going through these institutions. Okay. Do you have any question up to now? Does anyone want to ask any question? Any question? Today everyone is very silent. What are escrow companies? Yes, I'll be explaining that. Can we hold for a while? I'll explain it. Tishara, Tishara or Tishara. Any other things up to now? No? Okay, let's move on. Now here, before we move to the broader discussion of these different institutions, I want to highlight another point. And these financial intermediaries or institutions, they are providing various services, as we already know. And we have seen large number of institutions are basically financial intermediaries. So in this box, what we have all are basically financial intermediaries. Now, you simply know the process of financial intermediary. Intermediary is working as a middleman. He basically getting funds from somewhere and channeling those funds into somewhere. So that is his role. Based on that principle, we have all these institutions. But there are some institutions and providing services by those institutions in the nature of non-intermediation. So they are not directly intermediary activities. They are non-intermediary activities. For example, some institutions providing financial advisory services. I told you, there are financial planners. Some fund management agencies, they are also doing it. It's not directly intermediation. They are helping to do some management of the funds. So those are basically non-intermediary services. So in that sense, you can divide financial services into financial intermediary services or non-intermediary services. That is also a possible classification. The other word I want to highlight here is financial disintermediation. What is that? Now there what will happen if I go back to this diagram here. Now if you are going through this green channel, we know it is financial intermediary. What happens if you go through this blue channel? Blue channel means basically you are going through this direct financing method. Direct financing method means you are simply going through the market without having any intermediary. So that part which I have put it in blue color, you can call it disintermediation. The process that you are going through directly through the market to raise funds. The process going through directly to the market is defined as financial disintermediation. Okay. The word disintermediation means it's beyond intermediation. You are avoiding intermediation, right? So keep those terms in mind. Sometimes these financial disintermediation could include non-intermediary services as well. Financial advisory, fund management, etc., can be done by or can be done through disintermediation. So the point you want to highlight here or the keep in mind is financial intermediation and disintermediation are different. Intermediation is going through the intermediaries, indirect finance. Financial disintermediation is basically going through the markets. That is the idea. Okay. So with that, we complete the discussion or the overview of financial intermediaries. Clear? We started with different types of financial institutions. The first category is financial intermediaries. So we have defined and understood it in a broader sense. In the next part, we will go through each and every institution. Right? So before I move to that, I want to define financial service providers, the other type of financial institutions. Service providers are providing services in the finance industry. Okay. There you have a large number of organizations and services. Now, if you look at this list, right, there are various institutions providing various activities. Fund transferring, remittances transferring, providing credit cards, providing guarantees, financial derivatives, payment service providers, money changers, dealers, brokers, exchanges, security depositories, safe custody services, factoring services, crowdfunding services. All these are actually financial service providers. Unfortunately, we have to discuss all these things going forward. So in the next, as I said, this week and next week, we will be discussing all these different types of institutions. Then you will have some idea. Now, I want to highlight another point here before we move to the discussion on financial intermediaries in detail. Now, even though we have classified financial institutions as financial intermediaries and financial service providers, in practice, sometimes you can't have a strict distinction or strict separation between these two institutions, these two types of institutions. You cannot exactly say they are financial intermediaries and service providers. You cannot divide them into in a very black and white way, because some financial intermediaries may also be providing financial service. This example is, banks are providing banking service as well as investment advisory services. They are providing credit card facilities. Likewise, they can play different roles being a bank. So in that sense, you cannot have a clear definition or distinction between these two institutions. But that doesn't matter. We are trying to understand what these institutions are doing actually. For that matter, we have done this classification: intermediaries and service providers. With that, let's move to the first set of institutions. We have already discussed about these intermediaries, their definition. Now let's talk about each and every financial intermediary in a detailed manner. So in this list, we have all these intermediaries listed, key intermediaries. Now we are going to discuss them individually. Now, who are the most important financial intermediaries in your opinion? Who are the most important financial intermediaries? In most of the economies, if you look at, who are the most important financial intermediaries? What do you think? I'm just trying to, keep awake if you are sleeping. Who are the most important financial intermediaries? Maybe I'm asking a simple, stupid question, but let me have your answer. Who are the most important financial intermediaries? Gishani, yes, banks. Any other answers? How about others? One more answer, please. Does anyone want to give a feedback? Who are the most important financial intermediaries? Finance companies. Okay, Krishni. Okay, that's a different answer. Do you have any more answers? How about others? Today we have very few people, I guess. I think we have the half of the people compared to the other days. Insurance companies, okay, that is also a type of financial intermediaries. My question is the most important ones. How about others? What do you think? Hmm? How about others? Are they sleeping or already into the discussion? I see a lot of names. Okay, since we are running out of time, let's say the most important financial intermediaries are banks. Banks are the most important. I admit finance companies, insurance companies, they are also important. But in terms of the outreach, in terms of the services provided, in terms of the size, in many economies, banks are the most important financial intermediaries. So here I have put it in very clear way. Banks are the main financial intermediaries in most of the economies. Even in advanced economies, they are the most important financial intermediaries. Now, banking has a fairly reasonable history. I think banks originated, modern banking originated in the 12th, 13th centuries in the Europe. But even before that, even in the pre-modern era, we see evidence of banking in the advanced world, basically in the Europe. Modern banking practices, they have evolved since the Renaissance in the Europe, and then the Industrial Revolution in the 18th century in the Europe, and the discovery of the USA in the 18th century, basically. Actually, it's 15th century, 16th century, but they became a kind of a civilized, basically, starting from 18th, 17th centuries, and so on. So banking has evolved through many centuries, and in the 20th century, especially after 1980s, banking became a very important and rapidly evolving sector in many financial systems because of the process called deregulation. Deregulation means most of the banks in many countries, they were liberalized. They were allowed to act freely. They were allowed to basically determine their policies depending on banks' interest, their objectives, and shareholders' will. Most of the banks, actually, up to this period, were national banks, which means, government banks. Most of the banks after 1980s were national, basically privatized, which means they became private entities without having any government interference. So a lot of things happened after 1980s. And on top of that, one factor is deregulation. The other factor is development in ICT, information communication technology. They have provided major changes in the banking arena. So banking sector has transformed rapidly after 80s, especially with the development in the computers in 60s, and thereafter rapid changes in this technology in 80s, and there you see a lot of developments in the banking operations in terms of expansions, their size, geographic outreach, and all that. And if you want to add one more factor here, the third factor, probably you can say, the bank's evolution has become very fast in modern world because of the digitalization, right? So that word we use very often now, so I'll type it here, digitalization, where we have the digital aspect into the digitalization, because that has changed most of the activities in the banking system. Not only in the banking system, the entire financial system is changing rapidly because of the digitalization. So that is also an important factor. So here I have provided some information about for you to have, some general knowledge. This is not related to exam. What are the biggest banks in the world, right? Because the size is usually measured in a bank in terms of their assets, the size of the assets on the balance sheet. If you look at the asset side, what are the key types of assets and what is the total asset size? So that is basically the benchmark or the measure to measure the size of the bank. Now here in this thing I have extracted from I think Economist magazine. Uh, Here the biggest banks are given in terms of the capital, size of the capital. So that is also an indication of the size of the bank, because as you have more capital, which means your bank is having more operations and its size is bigger. So based on the capital indicator, now if you look at these numbers, the ICBC Bank, it's a Chinese bank, China Construction Bank, Bank of China, Agricultural Bank of China, they are the most biggest bank. So if you look at this list, most of the largest banks are from China, and the other banks basically from US, JP Morgan, Bank of America, Wells Fargo, Citigroup, all these are US banks. And then Mitsubishi Bank, it's a Japanese bank. HSBC, it's a UK bank. So if you look at this chart, I think the message is the most largest or the world's largest financial institutions in terms of banks are operated in countries like China, US, and uh, basically in UK, right? China, Japan, US, UK. This is some numbers from 2018. Probably now this could be changed because of the changes happened recently, but the message is very clear. Largest banks are in those countries. So what is a bank? Here we have the definition. So I recommend you tag this slide, because sometimes you might have to answer the definitions or give definitions for particular financial institutions. So a bank is a financial intermediary. That word is important because they are the major intermediaries that accepts deposits from the, let's say, the financial system, and channels those deposits into the lending and investment activities. I ask you to, keep an eye on this definition, because usually we say a bank is accepting deposits and giving loans. But if you look at this definition very clearly highlights two things. The banks accept deposits and giving those deposits as lending, which means loans, as well as for investments, right? So modern banks, they are not only giving loans, they are doing investments. If you take a bank balance sheet, which we will do in a while, uh, I have a slide on the bank balance sheet. If you look at that balance sheet, the bank's asset liability side is mainly coming from deposits, which means they are collecting money from the public. The bank's asset side, they have two major components. The first one is loans, giving loans to the customers, and the second one is investments. Investment could be in many forms. For example, investment in government securities, investment in shares, other investments, real assets. Likewise, banks are also engaged in investment activity. So in this small diagram, we have mentioned how this is operated. So the bank being an intermediary, getting savings as deposits, and to the borrowers you give loans. And as I said, you can put a stroke here and include loans as well as investments, right? Borrowers are basically who borrow money for these purposes as loans. Also in terms of investment money you can borrow, right? For example, if you are a government, you are a borrower, how do you get? Through investments in treasury bills or bonds. So that is also part of borrowings. And the borrower ultimately provides compensation for his borrowings in terms of interest, right? And savers get their money back as withdrawals, and they also get an interest. So this is a very typical scenario you can understand, but I just included it here for your for the completion of the discussion. One important point we would like to highlight here is banks are very regulated institutions. Oh, they are highly regulated. Regulated means banks are subject to controls and supervision. Now, I told you in 1980s banks are deregulated. That's true, which means banks are given some flexibility, liberal behavior or free behavior in terms of their investment activity, in terms of their financial activity and all that. That's true. They have that deregulated environment. But in terms of their activities with the public, they are very much regulated, which means controlled and supervised. Why they are regulated? Why the banks are highly regulated? It's not because of anything, because one important reason. What is this reason? Now, banks are the institutions who are doing business mainly on other people's money. Banks, if you look at balance sheet, as I said, on the liability side, their biggest liability item is deposits. I would say 80 to 90% of the liabilities are deposits. Their borrowings and their capital is very small compared to the deposits. So in most banks, capital is, roughly 10-15%. Capital is what? Capital is what owners have brought into the institution. So that is small. Deposits, what they have taken from the public. So in terms of public money, the banks are responsible for that money, and they cannot use that money in an irresponsible way. They have to ensure that public money is safe. To ensure the safety, in most of the countries, banks are highly regulated or highly controlled. Who is doing that? By the government. So the government is imposing high regulations and supervision on banks on behalf of the government, maybe the central bank or the financial service authority. They might be doing it, but they are highly regulated because they are very important in terms of in the financial system. So you use the word systemic importance because, as I said, they are doing business on other people's money, as well as banks are the largest financial institutions in many economies, as I said. In Sri Lankan economy, banks assets are closer to 60% of total financial assets. In most of the economies, banks are having a substantial amounts of assets in terms of the percentage. So they are considered as systemically important. Systemically important means if one shock is there, if a particular shock arises in the banking system, that could jeopardize or that could impact the entire financial system. That's why you call it systemically important. So banks are highly regulated because they are systemically important, and also they are related to the public confidence and public people's money, or the people's money is used. So keep that in mind, why they are highly regulated. So what is the importance of banks? In modern financial systems, banks are important because you cannot fulfill functions of money without a bank. What are the functions of money? We know there are at least 4 major functions of money. Money is a medium of exchange. Money is a unit of value. Money is a measure of storing value. Money is used for settling debt, which means deferred method of payment. If you imagine all these 4 functions in modern financial system, you cannot perform these functions without a banking system. Can you store the value of money without a bank? Can you make payments, future payments or loan payments without a bank? So you have to have a bank. So first and foremost, the most important function of a bank is they are helping to perform the functions of money. That's the really important function. So to support that, we can identify certain economic functions that is played by a bank. So what are these functions? Credit intermediation, we already know. Banks are borrowing and lending, or taking deposits and giving loans. Banks are doing maturity transformation, which means they borrow for the short-term purpose as deposits. Borrow in the sense they accept deposits in the short-term manner, and giving loans on a long-term manner. For example, banks are taking a maximum 5-year deposit and giving a loan a maximum for 25 years. So from short to long term, a maturity is transformed through the banks. So that is an important function. Banks are helpful to make the settlements of payments. Why? Banks are helping as collecting points of customer money. They are helping to do interbank clearing. They are helping to do settlements. For example, if you want to give a check, you can give a check to someone, and that's through the settlement process, that check is cleared. If you want to send money to anywhere, you can send money through the banking system. So that means they are helping to settle the payments in the banking system or the financial system. And one of the important functions banks are playing is they are helping to credit and money creation. You call it broadly money creation. How they do it? So banks, especially whenever we call banks here, that is basically commercial banks. Commercial banks are the major players of creating money. Remember, in our money discussion, we saw central bank is only providing a small quantum of money. If you take the entire money stock, central bank is only providing, let's say, 10% of the total money stock. 90% of the entire money stock is created by banks. Created by banks through a process called money creation. So process called money creation is done by banks because they are subject to this fractional reserve banking. Remember what is fractional reserve banking? The banks need to keep a fraction of their reserves, of their money with the central bank. So central bank is acting as a reserve storage. So they maintain a reserve account, statutory reserve account. So their banks are parking their money, a fraction of their money, and through that process, the central bank is, controlling the money creation process, right? So if you allow banks to create more money by changing that reserve ratio, that allows for money creation. If the central bank is changing that ratio, the money creation process would change. But all in all, overall, the central bank and the commercial banks are the main players of money creation. So this slide, as I said, is important if you really want to highlight the role of a bank in a financial system. You have to answer based on this guideline. So the banks are the key players to support the functions of money by performing various economic functions such as credit intermediation, maturity transformation, settlement, payment settlement, money creation. You can add some more things that you have learned from the previous slides. For example, they help, providing information. They help, to address information gaps in the economy. Likewise, you can, expand the answer, but at least you should have these key points in your answer, right? The last point I want to highlight today is a message that banking is a business. Why it is a business? They are not acting for charity. So they are basically into a business activity to earn profits. Now, as I said, the banks are responsible for two categories. What are these two categories? The first one, banks need to be responsible for depositors. So whenever depositors deposit money, the banks would need to give them a return, deposit interest. For that matter, banks need to have a income and they have to earn a profit. Second category that they are responsible is basically the shareholders. So shareholders, they bring money to the bank because they need a return out of that. Shareholders would need a capital gain, or they would need dividends for their shares. To pay them dividends or capital gains, banks should earn a profit. So to earn a profit, they have to run it as a business entity. So they have to run it as a business model. So banks fill a market by providing services, financial services for the customers, and they earn a profit. How do they do it? They do it through asset transformation process. They create assets by accepting these, liabilities, by accepting deposits, by bringing capital. They create different assets. What are these different assets? As I already mentioned, loans, investments. Through loans and investments, they make profits. Through making loans, they earn profits or income. Through making investments, they earn a profit or income. So that is used to compensate the depositors and shareholders in a bank. And when they do it, they are subject to various attributes like liquidity, raise, the size, everything. There are various characteristics that they should be looking at, but the process is very simple, very clear. It is running as a business entity to make money. To do that, they are into major business activities, right? If you summarize all these activities into one particular box, what are the activities they do? They take deposits, they borrow, they do lending, they make investments. You can also add they do payment and financial services for various economic stakeholders. So I would say the first four are the most important business activities of a bank: deposit taking, borrowings. Under borrowings, you can also include, within brackets, bringing shareholder money. They do lending, they do investment, and helping in the financial system to do payments and settlement activities, providing various financial services. So you cannot expect, now we have sometimes we have some complaints against banks. Banks are charging high interest, they are giving low deposit rates. Likewise, we have some allegations against banks. Sometimes those allegations could be true or valid, but sometimes you have to look at that in an objective way. Why? The principle is very clear. Banking is a business. They have to earn profits, they have to earn income to pacify their shareholders and depositors. And for the continuity of the business, for the continuity of the long-term sustainability of the business, the bank, they have to run it as a business model. So that is the last point I want to highlight today. Next week, we are talking about, through this business model, how the banks earn money and what are the different ways and means of banks earning money, and that would be our next discussion. Okay, so let's meet next week at the same time, and I recommend you go through the next slide. And someone asks questions, what are these different institutions like escrow companies? But if you look at the slides, I think definitions are given, but definitely I will be discussing. So read the slides, then you will have some understanding. Come back to the class, and I request you to look at the financial press. If we have new developments in the financial system, let's discuss in the next session, right? At the start of the next session. So be prepared. I think gradually we are reaching the exam time period also. Now it's almost half of the August month. We have already passed. I think in 2 or 3 months time, you will be having exam. So you have to start working now. Look at your materials, look at past papers, start doing exercises. Since we are in the virtual mode, it's really difficult to have exercises here on live basis, but I'm trying to do it in a maximum way. But let's try to find some time to discuss answers. So I really recommend you to look at the past paper questions. Most of the questions are available at the end of our slides, or if you can have the past paper set, then it's easy for you. But whatever the mean, you have to look at the past papers and get ready, right? Look at the new developments and be updated for the exam. Let's stop at this point. I'll see you next week, and have a good weekend. Okay, thank you.